how to calculate interest on hard money loans. We're going to simplify this and make this really easy. When it comes down to this, let's just say that your loan for the hard money is $100,000. Let's say 70 of that was for the purchase. And I know these are maybe not accurate numbers where you're at $20,000 for the rehab and you've got $10,000 for title fees and interest or whatever the case is. But your purchase, your rehab, your closing costs, all of that wrapped up is $100,000. And so your loan that you're getting from the hard money lender is $100,000. Okay. So people look at this in two different ways. There's a monthly rate and then there's an annual rate. Okay, so if your annual rate is 15%, then your monthly rate is, I take 15 if it's annual divided by 12, and the monthly rate is 1.25%. Okay, so 1.25% per month. Annualized rate is 15%. This is how I can figure out how much interest. So I take the 1.25 times it by the 100,000. And that make, 100,000 times 1.25, $1,250 in interest is basically where I'm at on a monthly basis. And so typically months are 30 days is what it's using. So I'm basically $41.66 per day is what I'm talking about, how much I'm going to be paying. Now, maybe you're paying that monthly, or maybe that is accruing and gets paid at the end. There's going to be some different calculations based upon that. But the general idea is you take the annual rate divided by 12 to get your monthly rate. Then your monthly rate you times by your amount with the purchase, the rehab, the closing costs, the loan amount that you're getting a loan for, not the money you're bringing. And if you're not bringing money, it'd be for the entire amount. And times that will get you your monthly interest. If you divide it by 30, it will get you your daily interest. So you may be saying, okay, I'm gonna have this property out, I think, for 6 months. What's it gonna cost me? $1,250 times 6 months, $7,550. Now that's just for interest. That's not gonna include any origination or title fees and those things, but we're gonna plan on that being covered as part of this money that's here. We're just talking about how to calculate the interest and what that is. So that's the easy way to do that, to get down and dirty, is figure out your annual or your monthly rate. If it's an annual rate, you divide it by 12 to get your monthly rate. You take the monthly rate times by the total loan amount, which should have everything included, which gives you your monthly interest. Divide that by 30 gives you your per day interest. And then you can times that by how many months you think you're going to have it out, or how many days you think you're going to have that out. And that is the interest, and an easy way to calculate it.